see the disposable income impacts are going to be there, but we're going to be cutting government spending, and so that's going to generate losses overall in the economy. Again, most of those are going to be within the government sector. Again, they're going to be fairly modest losses to the private sectors. We are going to see the increase in disposable income. So there's still going to be, again, an increase in disposable income, because even though personal income has fallen because of the job loss, a lot less of that is being taxed. So again, that is going to somewhat counterbalance losses elsewhere in the economy, where people have more money in their pockets, so they're still going to be able to spend more, even though they're earning less. And so that concludes the analysis of the governor's proposal. The next two sections on option A and option B are structurally the same. We're just going to be looking at different proposals. They're qualitatively going to look somewhat similar, in terms of, they're going to be, generally speaking, somewhat smaller or larger impacts depending on the static score that we were given, but the approaches are going to be the same. So I'm happy, I'll keep going and I'll describe the two options. But this may be an opportunity to jump ahead if there's appetite for that. I'd be happy to abridge some of these results.
Okay, before you roll into the next 2 or 3 proposals, on page 2 there you describe these scenarios, and you're going to use these 6 scenarios as you analyze the other tax proposals, correct?
That's correct.
So just a couple questions about those. For instance, on number 1 is no reduction in general state government expenditures. So, and then number 2 is with equal reduction in general state government expenditures. So does that mean that number 2 assumes a $180 million reduction accompanied with this tax cut bill in government expenditures?
That's right.
And I guess what I would mean is, obviously we have a forecast, and we always forecast a normal growth in the rate of government spending, and hopefully we finish up the year above the forecast, and which has been the pattern the last several years, with very few exceptions. When you say a $180 million cut in general state government expenditures, are you taking into account the normal increase that we always budget in, or is this saying we spent $6 billion this year, we're going to spend $5 billion, whatever minus $180 million is?
So thank you. So I would say that scenario would be saying you would not be taking into account the fact that there's kind of this ends up being this cushion. That you kind of.
So you're talking kind of like what happened in Medicaid, the $22 million real reduction from 1 year to the second year. You're saying that in these scenarios, you're saying there is a real reduction of dollars in general revenue spending of $180 billion in this scenario.
So again, and this would be relative to baseline growth. So it could be, these are all going to be looked at as kind of differences relative to a baseline.
So it does assume for some baseline growth.
Yes, that's correct.
So if we're growing at $150 million a year, it's really a net $30 million reduction in year-to-year dollars.
That's correct.
Okay. Okay, thanks.
And so again, just to, so this kind of gives you a sense of, if you didn't have that natural growth, what would be the cut that you would have to make? What would be the impact of that?
Yeah, and one more on the methodology. Explain a little bit more the difference between the extremes that you have there of income versus production assumption. Because again, there's a dramatic difference in the outcome of these, and is there anything that policy impacts which one of those scenarios is going to come to be?
Absolutely. So again, just to reiterate, so when we look at the kind of the personal income tax side, or kind of the disposable income side, we're saying the people's pay, the people's pre-tax paycheck is staying the same or is growing kind of as business as usual, but now they're taxed. They're less of that paycheck is being taxed, and so they have more of that to spend. And so that would be that's that side of the direct impact. So that's one approach.
So like in an S corporation that has 50 employees, the owner's going to realize the significant tax reduction at the top of this rate. And in this case, those that are making more than $80,000, the employees are going to notice a reduction or an increase in their disposable income.
That's correct. Under this approach, that would be the assumption. That the employees are going to be seeing the same pay pre-tax, but less of that is going to be taxed, and so they have more take-home pay.
Okay, thank you.
Okay, we have another question from Senator Irvin.
I'm right here. Thank you. I appreciate the different scenarios because I think it speaks to what dynamic scoring is and taking all these different types of things in consideration. And I'm assuming, you know, the formulas that you use and the different types of factors that are baked into the cake, so to speak, also take into consideration what's happening around us. I mean, I know we deal with 0% income tax in Texas, and we deal with 0% in Tennessee. I'm really concerned about the march in Missouri to lower theirs down, which I know they're anticipated down to 4% and then further down, particularly since Northwest Arkansas is where our growth in population has occurred. And I could see a scenario play out if Missouri gets down to a really low income tax. Would those factors and how does that continual change around us factor into these different scenarios? Is that accounted for?
Yeah, thank you, Mr. Chair. Yeah, Senator. So those are kind of future changes. What can be accounted for. So kind of the analysis of the current proposals would take into account kind of the current environment, kind of outside of the state. And if there's concern of looking at, if there's concern that these neighbors are going to be lowering their income tax rates and changing the relative competitiveness, that's something that would need to be accounted for in addition.
So in future years.
Yeah, and so that's something that could be analyzed, but it's as currently constituted. The analysis kind of takes the outside regions kind of given, but certainly that's an important thing to take into consideration kind of dynamically as you're thinking about the